Ever thought about, helping a friend out with a loan? Or maybe getting a really low interest deal from your boss? And you figured, hey, it's just a simple favor, right? No strings attached. Well, you might be in for a bit of a surprise. Because in the, let's say, interesting world of tax law, no strings attached isn't really a thing the tax man believes in. So today, we're doing a deep dive into something called imputed interest on the low market rate loans. Our mission, basically, is to figure out why the IRS cares so much about these, seemingly innocent financial favors, whether it's between friends, family, or even companies and their employees. And we'll uncover some, honestly, pretty eye-opening stuff about how these simple deals can have real, unexpected tax implications. It's kind of about seeing the hidden layers behind financial generosity. Okay, but before we get into the nitty-gritty, just a quick heads up. This deep dive is based on material from Farhat lectures. All the content, the examples, the explanations, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, you should definitely check out the website. They've got extra practice questions, video lectures, and tons of support to help reinforce what we talk about today. And a big thanks to Professor Farhat for providing this great material for us to explore. Okay, so let's unpack this IRS thinking, because it really flips things on its head for most people. The idea that, as far as the IRS is concerned, there's basically no such thing as a truly interest-free loan between people.
That's exactly it. It's a fundamental concept for them. The core idea is, look, if you lend money and you either charge zero interest or the interest is, way below what the market dictates, the IRS is going to step in and essentially calculate what they call foregone interest.
Foregone interest.
Yeah. And this isn't just about banks. It applies when individuals lend to each other, companies lend to employees, corporations to shareholders, you name it. Basically, any situation where money changes hands on favorable terms, and it's not strictly an arm's length deal.
Okay.
They're basically trying to stop people from, quietly shifting income around or disguising benefits as loans.
Right, makes sense. So if the IRS is going to impose its own rate, how do they figure out what that market rate actually is? Because my idea of fair for a friend might be, 0%.
That's the crucial question, isn't it? They don't just guess. They use a specific benchmark. It's called the applicable federal rate, or AFR for short.
AFR.
Yeah. And it's not some big secret. The IRS publishes these rates, and they actually update them monthly. Yep. Monthly. It serves as their official measuring stick for what they consider the right market rate. And they have different rates for short-term, mid-term, and long-term loans.
Got it. So foregone interest is basically the gap then. It's the difference between the interest that should have been charged using that AFR and whatever interest, if any, is actually being paid on the loan.
Exactly. You nailed it. Think of it like this. The IRS treats the situation as if the lender got the full interest payment based on the AFR. And then for whatever reason, maybe it's generosity, maybe it's an employee benefit, maybe it's a shareholder thing, that sort of extra interest was either gifted back to the borrower or just never collected. But here's the thing. Even if that extra money never physically changed hands, the IRS still sees it as income the lender should have earned.
Okay, wow. That sounds like it could cause some real headaches come tax time. How does this actually play out for both sides, the lender and the borrower?
Oh, it definitely can. For the lender, this is often the big surprise. They have to report that imputed interest, that foregone interest, as interest income on their tax return.
Even if they never saw a penny of it?
Even if they never saw a penny of it. The IRS treats it as if they received it. It becomes income on paper, even if it's not actually in their bank account.
Ouch.
Now, for the borrower, it's a bit different, a bit more nuanced. They might be able to deduct this foregone interest, but, and this is a big but, only if the interest would have been deductible if they'd actually paid it.
Okay, what does that mean? Like if it was for business?
Sort of, yeah. If the loan was used for something the IRS generally allows interest deductions for, say, interest on a home mortgage, certain student loans, or maybe a loan used specifically to buy investments like stocks or rental property, then maybe they can deduct that imputed interest.
So let's say I lend my brother some cash, maybe 10 grand, to help him pay off his credit card debt. That's usually personal debt, right? He wouldn't be able to deduct the imputed interest the IRS might calculate on my end.
You've hit the nail on the head. In that situation, where the loan is for a purely personal purpose, paying off credit cards, buying a personal car, that kind of thing, the foregone interest is considered personal interest.
And that's not deductible.
Exactly. Personal interest is generally not deductible for the borrower. So for your brother in that case, no deduction on his side even though you might have to report income.
Man, this whole idea of the IRS seeing these invisible transactions is, well, it's fascinating. So what specific types of loans are really on their radar for these imputed interest rules? Is it every single handshake deal, or are they focused on certain categories?
Good question. They've definitely zeroed in on specific categories. These are the areas where, the potential for shifting income or avoiding taxes is seen as higher.
Yeah.
First off, and probably the most common one people run into, are gift loans.
Like between family?
Exactly. Loans between individuals, friends, family members, where you charge little or no interest. The IRS might look at that foregone interest and say, okay, that looks like a gift from the lender to the borrower. And that gift itself can have tax implications, potentially even for the lender who technically never received the money.
Huh. Okay, what else?
Next up, compensation-related loans. Think about your employer giving you a loan at, say, 1% interest when the market rate is much higher, or maybe even an interest-free loan.
Yeah.
The IRS sees that foregone interest, the benefit you're getting, as a form of taxable compensation. It's like getting a bonus or a raise, just structured differently. Same logic applies between independent contractors and their clients, too.
All right. Makes sense.
Then you've got corporate shareholder loans. This is when a corporation lends money to its owners, the shareholders, at a below-market rate. Again, the IRS views that foregone interest as a taxable benefit flowing from the corporation to the shareholder. It could almost look like a disguised dividend payment.
I see the pattern here.
There's also a serious one. Tax avoidance loans. This is kind of a catch-all. It's any below-market loan where the IRS determines the main reason, the primary purpose for the whole arrangement was just to dodge federal taxes.
That sounds bad.
It is. If they figure that's the intent, these loans are always taxable, and it's treated as a pretty serious issue. They don't mess around with intentional avoidance.
Okay. Any others?
One more specific one. Loans to qualified continuing care facilities. This is a bit niche, but important. It applies to loans someone might make to a retirement home or similar facility under a continuing care contract, especially if the lender or their spouse is 65 or older. This rule exists to prevent potential abuse, like using loans to essentially prepay for care in a tax-advantaged way that wasn't intended.
Gotcha.
So, yeah, in all these scenarios, the IRS basically imputes interest. They draw that imaginary line, treat the loan as if it had market rate interest, even if the paperwork says zero. And boom, tax consequences follow for both parties.
It really sounds like the IRS is focused on the economic reality, doesn't it? What's really happening financially, not just what the agreement says on paper.
That's a perfect way to put it. Economic reality is key.
Okay, so let's make this really concrete. Can you walk us through an example? Show us how the numbers actually work.
Absolutely. Let's take Alex and Jordan again.
Okay.
So Jordan lends Alex $15,000. Jordan's feeling generous, sets the interest rate at just 2%. Seems straightforward, a nice gesture.
Yeah, sounds like it.
But let's say when they made this loan, the applicable federal rate, the AFR published by the IRS, was actually 4%.
Okay, so there's a gap.
Exactly. So here's the calculation. If Jordan had charged the official AFR of 4% on that $15,000 loan, the interest should have been $600 for the year. That's 0.04 times $15,000.
Right.
But under their agreement, the actual interest Alex is paying is only 2% of $15,000, which is $300.
Okay.
So the difference between what the AFR says should have been paid, $600, and what was actually paid, $300, is the imputed interest. In this case, it's $300, $600 minus $300.
So $300 of phantom interest.
You could call it that. Now here's the kicker for Jordan, the lender. Jordan has to report that $300 of imputed interest as income on their tax return. That's in addition to the $300 they actually received from Alex.
Whoa.
So Jordan ends up reporting a total of $600 in interest income to the IRS, even though $300 of it only existed, conceptually, according to the IRS rules.
So the IRS sees it like Jordan got the $600.
Yeah.
And then basically gifted $300 back to Alex, or just chose not to collect it. But from a tax perspective, the income was imputed to Jordan. It's that as-if concept hitting home.
Wow, that's crystal clear. And yeah, definitely underscores how this can create income out of thin air, tackle-wise, for the lender. Makes you pause before offering that super low rate to Uncle Bob, huh?
It certainly should make you aware of the potential consequences, yes.
But surely there must be some situations where the IRS cuts us some slack, like a don't worry about it rule, because calculating this for every tiny loan seems excessive. Thankfully, yes, there are some important exceptions. The main one is often called the de minimis rule, basically for small amounts.
De minimis, okay, meaning small.
Exactly.
Yeah.
Generally, for loans up to $10,000, the lender usually doesn't have to worry about calculating or reporting imputed interest income.
Ah, okay. That's a relief.
It is. It simplifies things for those really casual, small loans between people, provided, it's not primarily set up just to avoid taxes. There are always conditions.
Right. So break that down a bit more.
Mm.
How does it work for different types of loans under $10,000?
Okay. So for gift loans, say, between individuals of $10,000 or less, the imputed interest rule generally doesn't apply if, and this is key, the money borrowed is not used for income-producing assets.
Meaning?
Meaning, if a parent lends their kid $9,000 to help with rent or buy a car, probably no imputed interest. But if that kid takes the $9,000 and invests it in the stock market or buys a rental property.
Ah, then the exception might not apply.
Exactly, because now the loan is generating investment income.
Got it. What about those work-related ones?
Good question. For compensation-related and corporate shareholder loans of $10,000 or less, the imputed interest rule usually doesn't apply if tax avoidance is not the primary purpose of the loan. This allows for, small, maybe short-term, low-interest advances or loans within a company or between a company and owner without immediately triggering tax issues, assuming there's a legitimate business reason behind it.
Okay, that $10,000 threshold seems pretty useful. Are there other exceptions beyond just the loan size?
Yes, there are several others, often based on public policy or standard business practices. For instance, government-subsidized loans, like many federal student loans, are typically exempt. The government is intentionally offering a low rate, so it's not seen as a tax dodge.
Makes sense.
Also, think about business-related loans offered to the public. Those 0% financing deals on cars or special low-rate credit card offers.
Right.
Those are generally exempt. They're seen as standard marketing tools or business practices to attract customers, not as below-market loans trying to avoid taxes in the way these rules target. Employee relocation loans are another one. If your company gives you a loan specifically to help cover moving costs when you relocate for the job, that's usually exempt too. It facilitates the move. There are also some specific rules for certain international loans, and importantly, for gift loans made to charitable organizations. If the total outstanding loan to a registered charity, like a 501c3, is less than $250,000, imputed interest generally doesn't apply. That's clearly there to encourage charitable giving.
That's good to know about the charity part.
Yeah. So overall, these exceptions recognize situations where imputing interest would either go against other policy goals, like education or charity, or where it's just not necessary because it's a standard accepted business practice or a very small amount.
That's a huge relief, honestly.
Yeah.
Especially for those smaller everyday loans. But what about gift loans that are like bigger than that $10,000 de minimis amount, but maybe not enormous, say 50 grand? Or up to $100,000. There are special rules there.
Ah, yes, absolutely. And this is a really important area for gift loans between individuals, specifically when the total outstanding loan amount is $100,000 or less.
Check. What happens then?
So if the loan is $100,000 or less, and the borrower uses the money for income-producing assets, remember, like stocks, bonds, rental property.
Right, generating income.
Then the amount of foregone interest the lender has to report as income, and that the borrower potentially could deduct, if applicable, is actually limited.
Limited how?
It's limited to the borrower's net investment income for that year.
Okay, net investment income. Can you just quickly remind us what that usually includes?
Sure. Net investment income is basically the income the borrower earns from their investments. Think dividends, interest income, rent, capital gains, minus any related investment expenses they might have.
So if the borrower doesn't make much investment income that year,
then the amount of imputed interest the lender reports is capped at that lower amount. It can't exceed what the borrower actually earned from investing the money, essentially. And there's an even simpler rule within that. It's for low net investment income. If the borrower's net investment income for the year is $1,000 or less, then the foregone interest is treated as zero, zip, nada.
Oh, wow. Okay, that's a big simplification.
It really is. It helps avoid complex calculations and reporting for relatively small-scale situations where the investment return is minimal.
But I sense a catch coming.
You guessed it. There's always a catch with taxes, right?
You'd like it.
These limitations, they cap based on investment income, and the $1,000 rule, they do not apply if the main purpose of the whole loan arrangement is tax avoidance.
Ah, there it is again. Intent matters.
Intent matters hugely. If the IRS looks at it and decides a loan was structured that way, primarily to play games with the tax system, then forget the limitations. The regular imputed interest rules apply in full force, regardless of the loan amount or the borrower's investment income. They really don't like being played.
Makes total sense. They're looking for genuine transactions. Okay, perfect time for a quick, check your understanding moment for me and for everyone listening.
Excellent idea. Let's do it. So, thinking about those gift loans of $100,000 or less, when is the foregone interest treated as zero? Is it A, when the borrower's net investment income is more than $1,000, B, when the borrower's net investment income is $1,000 or less, or D, it's treated as zero regardless of their net investment income?
Okay, let me think. We just talked about that simplification rule for low income. So it kicks in when the income is minimal, right? To avoid the hassle.
Yeah.
I'm going with C. When the borrower's net investment income is $1,000 or less.
Bang on, you got it. That's exactly right. That rule provides significant relief and simplification when the actual financial impact from the investment is really small. It keeps things manageable.
Phew, okay. Glad I was listening.
Mm-hmm.
So wrapping this all up then,
Yeah.
what does this actually mean for you listening out there? We've gone pretty deep into this surprising world of imputed interest. And I think the big takeaway, for me at least, is how the IRS really looks at all financial dealings, even between friends and family, through this lens of economic reality, not just your good intentions. That interest-free loan you give or get might not be quite so simple when April rolls around. It's almost like the tax code is this invisible third party in the conversation running calculations.
That's a great way to think about it, and understanding these rules is just, well, it's crucial if you want to navigate your financial relationships smoothly and avoid those unexpected tax hits. The IRS focuses consistently on the true economic substance, what's really going on, not just the label you put on it, like calling it a loan if it acts more like a gift or compensation. They want to make sure income isn't being artificially shifted or hidden. So maybe the thought to leave everyone with is this. As you think about lending or borrowing in the future, even informally, consider how these rules kind of reflect the deeper scrutiny the IRS applies to arrangements that could be seen as shifting income or avoiding tax. How might knowing this change how you approach things, even with people you trust completely? Always keep in mind those as-if scenarios the IRS might construct. And remember, just because an agreement feels simple and has no strings attached verbally, the tax code might see strings you didn't even know were there.
That is definitely something to chew on. Really makes you think differently about casual financial arrangements. Well, thanks so much for walking us through that complex topic, and thanks to all of you for joining us on the deep dive. We really hope this exploration of imputed interest leaves you feeling more informed, maybe a bit more cautious, but definitely more prepared. Keep exploring, keep asking questions, and remember, if you have specific tax situations, always talk to a qualified professional. Until next time.